day, everybody. This is David Friedman with my co-host Dave Berkus on TCA Crossroads, where entrepreneurs and investors connect. How are you, Dave?
I'm doing great, and it's a great day today because it is mid-year. We are early on and able to analyze, in this case, the JP Morgan 2025 Global M&A Mid-Year Outlook Report. And it's nice for us to be able to tell people about it before they have a chance to read it. And so we're going to delve into that today and get some real insights into what's going on in the investing world.
Yeah, I'm extremely excited. I had the privilege of reading part of that report, and there's a lot of different issues that they point out that I think are very valid for the investor community. I take issue with a few of them, but I'm going to let you drive this one and go through the report, and then I'll provide commentary and debate, discussion as we go along. But I'm so excited to hear what you have to say on the report. And I'm sure the audience is also going to appreciate it. And by the way, if you're watching this and you like it and share it. We are very interested in getting the word out about TCA Crossroads to all those people that are entrepreneurs as well as investors.
We are on, and I want everybody to see the title, which is Navigating Uncertainty. And that is what I think you're going to find from this report is important. So I will point out various portions of the report for you. The first thing to say is activity slowed during this policy uncertainty we're talking about, and the strong volatility in the market, primarily driven by the tariffs, but by a few other things as well as expected interest rate decreases. So if you look at the box in the lower right, that is 2025's first half. And what you're going to see in that box, and I know you can't see it very easily, is that there are 1,114 first half global M&A events. Now, that's the dark blue. If you look at the same point in 2024, which is immediately left of where that red box is, you'll find that in the first half it was 1.7 and compared to 2.2. So the good news is there is more activity in volume than there was in 2024. 2.2 trillion, as a matter of fact, which is a very good thing to know. That's a 57% increase in the number of mega deals. That's over $1 billion deal. And 72% of the volumes turned out to be consisted of deals that were greater than $1 billion. That's a 20-year high. So we've been talking in past half-year and quarterly reports about some degradation, and the fact that we had a high in 2021, followed by a semi-high in 2022, and then someone turned out the lights. And in 2023 and 4, we kept saying, wait till 2025. And it looked for January and February like 2025 was going to be a bust. But what you're going to see today is just the opposite. And that's why I had to tell you that, to give you an idea of where we think we're going to go based upon where we were in the first half. So the next slide is tariff policy. Initially fueled potential stagflation. Stagflation is where prices go up, which is the bad part of this, and costs go up, which is part of this as well. So inflation increases at the same time as the economy is stagnant or even sometimes decreases. Stagflation is the worst place to be. Well, maybe high inflation is the worst place to be. So if you look at the S&P 500, you'll see that on April 8th, 2024, that's the dip in the left-hand side, that was the day that Trump announced the tariffs, the gigantic tariffs. And then the market kind of resolved, and Trump, you may recall, a day later, took away what he had put on the table. And so the market rebounded in the greatest single daily rebound that we've had in the last several years. So it is a little strange that we're talking about all this today, but we kind of have to. So business has now adjusted to the new norm, and you'll find that we are up 6.4% for the S&P 500 this year so far to date as of June 30th. Remember, this is the first half report. So there we start delving into M&As. So, despite the challenge at the start of the year, more than half of the sectors globally saw double-digit growth in volumes. So, I'll point out just a few that we're interested in. Look at the 42% increase in technology year on year. Look at the 3% decline in healthcare and 9% decline on energy. And just to point out one more, diversified industries, which sometimes we often invest in as angel investors, are up 41% year on year. So M&A volume by sector turns out that technology is 22% of all the volume, and diversified industries 21%. Healthcare, even though it was down, was still 8.9%. It's hard for you to read, but that's the graph on the right-hand side. I know I'm going fast, but this is a lot of data, as you can kind of tell.
I see that the healthcare has declined by 3%, yet from TCA's perspective, I'm seeing actually an increase in the number of angel deals coming into the system. So eventually, I think that will show an increase in the number of M&A activities over time, however long that takes.
I think you're right. Okay, so the next slide that's on the screen right now reflects on this first half. This is in a constantly evolving environment. It speaks to sponsors and strategics. And these are terms that we don't often hear, but JP Morgan chose them. Sponsors turn out to be VCs in our case, or angel investors. Strategic investors speak for themselves. So now if you look, now that I've said that, at the far right-hand side, you'll see, first of all, the red line that goes through all of these halves for all of these years past. We are above it. We are above the standard norm for number of strategics, that is the dark blue line, and sponsors, the light blue line. This is good. So M&A by strategics is up again. Whoa, be happy about that. I am actually involved in 2 deals right now at this moment in time with TCA companies being sold based upon the beginning of 2025. We hadn't seen that at all for the last 2 years. So for some of us, a celebration is in order. All right, let's move on to the next slide. The regulatory environment, you might guess, including protectionism, meaning our tariffs, is influencing not just here, but the global M&A activity. And that's all I have to say about this slide until we show it in graphic format. And it says, despite the complex protectionism, cross-border activity has persisted. Now, I'm not going to ask to have you look at each one of these countries, but what it's saying is global M&A is important. One of my companies got an offer from a company in Germany. So it is happening again, and it's nice to see. By the way, that's a TCA company. And by the way, that is only an LOI. So we're not at a point yet to make any announcements, but it does say activity is increasing quickly. The regional nuances paved the way for M&A activity. And the darker countries that you see are the more active countries. And that's really all you have to get out of this particular chart. But notice the activity gets down to places like Brazil and Chile. All right, so the regional spotlight, which again, we're not going to spend much time on, it's something to do with the geopolitical challenges in the complete microeconomic uncertainty that we're in the middle of right now. So if you look to the lower right, the M&A announcements, the deal, the count by size anyway, look at the very large deals, which is the fourth bar that it's no bar at all. It's 0%, which deals over 10 billion. There were none in the first half. From 2 to 10 billion, there were 296. From 1 to 2 billion, there were 29%. And is 32% from 1 to 2 billion. And finally, the smaller deals, the ones that maybe fortunately or non, are the deals that we angels participate in from 25 million to $1 billion. That turns out to be only about 6% of all deals. But it gives you a point. 6% of all deals, I'll take it. I'm happy to see them that high again. So what are the drivers for activities And we'll use the word sponsors again, which I know is a little unusual, but that again means venture capitalists. We angels are sponsors too, to a degree.
Mhm.
So there are 6 things to say quickly. Number one, trophy assets and mid cap are the center of sponsor exit activity. Mid caps. We don't often qualify for mid caps. The average exit for an angel is $40 million. That's just an average. For the ones that really make the big numbers, the 500 million to $1 billion exits, we angels celebrate them, and there are those that we have. I had 2 of those in 2021 and 22, but there aren't many. Number 2 out of 6 is sponsors remain active and optimistic. That means venture capitalists and angels are active and optimistic. And number 3, strategic exits should continue to be the highest priority for us, angels and VCs. That is sale to strategics, not IPOs. You'll see that in a minute, and not gigantic exits to P&E. Number 4, in infrastructure and impact funds should continue to be active. Impact funds, as you probably know, are those that deal with companies that help the environment, help certain industries to be able to be more efficient. Impact funds are important. And there are a couple of those in Southern California, one of which I'm active with. Number 5 out of 6, continued focus on P2Ps and take privates. Wait a minute. Take privates? Yes, because I'm going to show you a slide in a minute about what happens with public IPOs. And finally, the alternative deal structure and monetization paths have become more active, which means people are doing deals that are strange. They aren't IPOs, as we'll see from future slides. David, I'm going to stop there for a second, let you comment, because I'm moving fast.
No, I think that what you have makes sense. I mean, I've seen the same. I don't see any differences in the TCA type of deals that are coming in. We're seeing some more exits, but it's been a slow last couple of years. I'm more interested in the funnel than I am on the output side at this point. So I'm waiting for the JP Morgan stats on what's happening in the market in terms of investments and all. So I'll comment more on those.
Then let's handle that right now. If we talk about the financial sponsors, remember that's us again, are expected to prioritize capital cycling. I'm going to have to define that, and rebalancing to a 5-year fund duration. The funds that we have been investing in, and this means the funds for TCA's individual chapters, as well as the 3 ACE funds that I manage, and funds by all angel groups across the country, have all called themselves 10-year funds. I don't know of any that have ever liquidated at 10 years. 12, 14, 16. Some of our biggest deals are at 18 years, and funds don't like to know that. So if you look now at the upper right-hand side of the several graphs that are on this one, these are the U.S. private companies that are still left within funds over time. Well, that reduces the compound annual growth rate because these are in there longer and longer as these individual companies mature. And that's why that portion of that particular graph goes down 1.9%, in fact. If you go to the left-hand side, you'll see that between 2015, which is the first of the 3 bars, there were 7,600 aging U.S. inventories. That means companies left that weren't sold. If you look at the second quarter of 2025, which is the dark green in that left-hand one, 12,000 companies are sitting here unsold in different funds, large and small. Look at that. That is almost double. It's maybe a 70% increase from 2015 to now. That's a lot of companies sitting there waiting for something to happen. And then finally in the lower left is not something we should spend time on because it's typical. This is distribution of paid-in capital by vintage year. Well, the earlier the vintage year, in this case, the graph goes as low as 2014, the more distributions the limited partners have received. That's a duh, and it just means there hasn't been much distribution in the 2024 funds. Don't worry about it. Now we move to increased types of activist appetite amid a volatility that we have just talked about. And I'm not going to spend much time on this one, except the little tiny circle that you see in the end of Q1 2025. And it is impossible even for me to read. So I'm not going to be able to do well. But that was Liberation Day. You remember that? Liberation Day was the day that Trump said we're going to add 50% tariffs to everybody. Well, suddenly the volatility of the US markets, the world markets, went way high for a day. And that's all that graph tries to tell you, other than other things which we expect. Let's turn to AI-driven transformation, fueling the growth, and data center investments. Now we're talking AI, and we're talking investments in AI. So the first thing to look at is the first bar on the left-hand side, which is AI compared to all other industry segments. And this is, again, in the trailing 12 months. So what are the top 10 areas of investment? Duh, AI. And that is 12,527 companies. Compare that, just for the fun of it, to the services sector, which is the last little bar on that same left-hand graph, for 533 companies. 12,000 down to 500. Get the idea? AI investment numbers are way up. But if we look at the global data center capital X forecast, the expenditures in billions of dollars for the last year or two, we're on that same graph right now. So the graph starts, this is the right-hand graph, at 2020 for $194 billion. Look at what's expected in the far right-hand bar, 2028. That number is $587 billion just in data centers. That's an 18% compound annual growth between 2025 now and 2028. If you were able to invest in only that one thing and nobody knew about it, so therefore you got the first chance to make money on this, that is a gigantic opportunity. Problem is, the big investors beat you to it. And so you'll find that data center investing is not something to place to make money right now. So, David, if you look at this one, this is important for us to spend a few minutes on. Uncertainty, which is what we have to deal with every day as angel investors, it's here to stay. This is not a typical environment as we knew it a decade ago. So what are those uncertainties that face us right now as of the end of the first half of 2025? Well, trade and tariffs, number one. Number two would be the economic uncertainty that is always here. But policies, government policies, have changed the entire environment. If we talk about what are we doing next as far as the Federal Reserve, the interest rate, government policies, not just about tariffs, but about investments, about having a sovereign wealth fund. I can keep going forever. So economic uncertainties. Number three is the third one down on the left, and that is rates and inflation. Inflation is 2.4% right now, which is okay, but it is rising, and that is not good. And down at the bottom, the evolution of U.S. foreign policy. Very difficult for us to follow foreign policy as it is being developed and changed with the current administration. Go to the next one on the lower right-hand side, geopolitical risk. But the ongoing disputes and cross-border tensions, we've got to worry about that as investors. Then in the center on the right-hand side, regulatory environment, there are so many approvals and so many jurisdictions and so many things happen. For instance, the government taking away from universities the kind of money that was going toward university research. What do we do if we invest in companies that are the outgrowth of university research? Ouch. And then finally, on the upper right, currency fluctuations. haven't affected us as badly as it has some other countries. But the shock is some of those countries have had to devalue their currency big time. Now, I've gotten through it all in a period of about, I'm not going to even count the number of minutes, but we're going to take a breath because I moved really fast here, David. If you'll make some comments, if you'd like to, about this, but it tells you that we are navigating uncertainty, that the reasons I've just given you a second ago cause for a little bit of concern at the same time as the amount of investment, particularly in AI, is up.
Yeah, so I do see the investments in AI up, especially in the later stage rounds, and that's where you're seeing a lot of investments by the VC and the PE companies come in. A lot more companies on the input side. What I'm also seeing, and it goes to a lot about this chart on uncertainty, is the way that the angel psychology has been changing and the new angels that are coming in. We're seeing a lot more angel investors, for example, coming in from the corporate world, a lot of younger angels that have less patience than we do. They're seeing more options in the equities market. So they're looking at angel investments versus maybe options trading, for example. Covered call options is real safe, and as you pointed out, it's longer. It takes a longer time to exit in an angel investment. Therefore, that reduces the average rate of return. And if I can get 15 to 18% in options investing with that risk, and remember, covered call is less risky than just speculative options, I may be better off with other financial areas in investment than doing an angel. So we're seeing pressure across the board in the angel world, recruiting members, sustaining and keeping members. So I look at that. Also, in line with that uncertainty, I believe we're seeing many more safes coming into the market. Safes is literally a safe way that the entrepreneur can, get money. Most of the angel groups will not consider a safe that's
I was
uncapped
going
or
to say that.
safe. It's like an IOU. But what we're seeing is that, and I think JP Morgan in one of their studies, maybe even in this one, pointed out that about 90+% of pre-seeds are now going to the safe mode. And that is problematic because it's not going to attract the angel capital. We're seeing a decline in convertible notes. But the interesting thing, as we talked about, I guess, before, is the big, beautiful bill with the 1202 change. You're almost better off doing the preferred equity route because now you have a tax advantage, particularly on the federal level. And for those states that follow federal guidelines, after 3 years, you buffer 50% of the profit, 4 years, 75, and 5 years in 1 day, 100%. So there are a lot of different moving parts today vis-a-vis when you and I started, angel investing many, many years ago. I just point those out because I think this uncertainty is driving a lot of the way that the angels are thinking today and the way the investments are going. I wanted to just point that out for whatever reason.
Let me remove this from the stage so we can see each other again.
Oh,
At the
hi,
same
Dave.
time, hello, David. At the same time as, let me emphasize what you just said. There are goods and bads. There are two sides to this coin. The first side is the government has given us an opportunity to make more money earlier that is tax-free. The bad side is it'll take longer for us in the general to make the big, big money that we're all hoping for. And we angels are, in a way, gambling. But think of it this way. We're creating jobs. We created millions of businesses as a group of angels over the years. And we certainly have helped this economy to a degree that big companies who reduced employees were unable to do it. So we are doing well by doing good. And I certainly don't want to speak against the angel environment at the same time as I want to reset the expectations, as you just did, to be a little more patient than we've been in the past.
So can I make another comment? I think
No.
what we're also, oh, no? Okay, well, I'll do it anyway.
Yes, I can. Go ahead.
Yeah. So when we've had discussions before on AI, we stay on AI. Now, AI is becoming more integrated both on the entrepreneurial side with people like Peachscore, Dealum and Peachscore, the TCA Investment Readiness Report and all. But we're also seeing the use of AI both generative as well as agentic AI helping make better investment decisions. So what we're seeing is it takes longer to get your money back, but I believe the use of these new tools is going to help the investor. And that's not only angel, but it's the VC, it's the corporate VC, the family offices, make better investment decisions because of the ability to pull in different data from different sources. And what I call reducing the risk by avoiding the blind spots in investment. Because like a new puppy, I'm interested in this great business and I'm so excited, but I kind of forget the fact that there are a lot of elements that you need to take a look at. And I found, and maybe you have a different point of view, that reducing the risk and managing that risk becomes really key to making a good return as an angel investor.
Well, there is a great summary from which we can kind of close out. David, that was an excellent summary that you made. And the JP Morgan report is one that I think we ought to pay some attention to. And maybe in sometime in the near future, we'll try the PitchBook report, which gets down into more detail about angel investing. David, thanks for allowing me to give you that one, and your comments are well noted.
I love this, Dave. I think you do such a great job in taking these reports, parsing it down to usable and informative information for our viewing and listening audience. For all those out there, take a look at the report, take a look at Dave's information today and in prior podcasts and in his writings. Hope it helps you in your investing, and I hope it helps the entrepreneur in coming up with a really good business and growing the business. For us on TCA Crossroads, we wish you success in investing, and we will see you next time. Thank you, Dave.